The current market status for Beyond Meat Inc., ticker BYND, reflects a definitive closing valuation as of the final bell on Friday, November 21, 2025. The market is currently closed. At the close of the last trading session, Beyond Meat stock settled at precisely $0.87 per share. This figure represents a decline of approximately 0.68% during the Friday session, capping off a tumultuous week where the equity oscillated between an intraday low of $0.81 and a high of $0.90. The stock is now firmly entrenched in penny stock territory, trading significantly below the psychologically critical $1 threshold, a reality that places it in a precarious position regarding NASDAQ listing compliance and long-term viability. To understand the gravity of this $0.87 price point, one must look at the broader volatility. The stock has shed roughly 30% of its value in just the last month alone, creating a severe divergence between the persistent retail hope for a turnaround and the brutal, cold calculus of the bond and equity markets. The expectation for Beyond Meat has long been one of disruption, a belief that this company would fundamentally alter the global protein supply chain, commanding a premium valuation akin to a technology firm rather than a food processor. Investors were pitched a narrative of exponential growth, where plant-based meat would become ubiquitous. The reality, however, as indicated by the $0.87 closing price, is a company fighting for its financial existence amidst shrinking margins, waning consumer demand, and a balance sheet laden with convertible debt. This is not merely a dip, it is a structural repricing of the business model. While many retail traders holding positions on Robinhood or SoFi Invest may look at the sub-dollar price and see it cheap lottery ticket, the institutional view is far more cynical. The tension here is palpable. The retail expectation of a squeeze or a miraculous recovery is colliding with the reality of cash burn and dilution risk. If you are looking at your Fidelity mobile app right now, staring at that 0.87 figure, you are witnessing the aftermath of a growth story that collided with high interest rates and changing consumer tastes. Analyzing the specific trading mechanics of the last session reveals intense distribution pressure. On Friday, the stock opened at $0.87 after some pre-market fluctuation and failed to gain any significant traction, despite the broader market showing resilience. Volume was notable, with over 2 million shares changing hands, yet this liquidity did not translate into upward momentum. This suggests that for every buyer stepping in at these lows, there is a motivated seller, likely an institution or a weary long-term holder using the liquidity to exit the position. Unlike Nvidia stock, which often sees buying pressure on dips due to robust fundamental backing, Beyond Meat's dips are being sold into. This behavior is characteristic of a stock in a secular downtrend, where rallies are viewed as exit opportunities rather than entry points. When you compare this price action to Tesla stock or Apple stock, which maintain structural support levels even during corrections, Beyond Meat's inability to reclaim the $1 mark is a screaming technical red flag. The intraday movement on Friday also highlighted a lack of conviction from the bulls. The price touched $0.90 briefly, but was immediately slapped back down, indicating a wall of limit sell orders sitting just overhead. This resistance level is crucial. For those utilizing Interactive Brokers trading platforms or Schwab Intelligent Portfolios, the order book likely shows a stack of sell orders between $0.90 and $0.95, creating a ceiling that the stock struggles to break. This is the reality of the current market structure for BYND. It is trapped. The Robinhood app users who bought in at $5, $10, or higher are now effectively locked out of the conversation, leaving the daily price action to be dominated by high-frequency algorithms and distressed debt traders. Let's pause for a moment. Comment below how many shares of Beyond Meat you currently hold or if you managed to exit before the drop below $1. I want to know if you are dollar cost averaging at these levels or if you have thrown in the towel. Deepening the analysis, we must address the fundamental disconnect that has driven this stock to $0.87. The expectation was that Beyond Meat would eventually achieve price parity with animal protein, thereby unlocking mass market adoption. The reality is that inflation has made consumers incredibly price sensitive. While Walmart and Costco shoppers might have experimented with plant-based burgers when they were flush with stimulus cash or when the economy was running hot, the current economic climate has forced a retreat to basics. The premium pricing of Bond's products, combined with questions about ingredient lists and processing, has stalled the growth engine. This is not merely a company problem, it is a category problem. However, unlike competitors such as Tyson or Kellogg's, who have massive diversified portfolios to cushion the blow, Beyond Meat is a pure-play exposure to this specific struggling vertical. For those using Fidelity Investments or Fidelity Wealth Management Services to construct a long-term portfolio, the inclusion of a stock like BYND at this stage is often flagged as speculative or high risk. This is because the company's financials are showing signs of severe stress. The cash burn rate is the primary enemy here. Producing plant-based meat is capital-intensive. It requires factories, extruders, complex supply chains for pea protein, and massive marketing spend. When revenue contracts, as it has recently, the fixed costs eat the company alive. The recent news regarding the conversion rate of their convertible notes adds another layer of complexity. Convertible debt is often a tool used by growth companies, but when the stock price collapses, that debt becomes a noose. If the debt holders convert to equity at these low prices, the dilution for existing shareholders would be catastrophic. If they demand cash, the company's liquidity is tested. This financial rock and a hard place is what is keeping the price pinned under $1. Furthermore, we need to discuss the role of online investing platforms in this narrative. During the 2020-2021 boom, platforms like Robinhood Stock Trading and SoFi Invest democratized access to the markets, allowing millions of retail investors to pile into concept stocks like Beyond Meat. This created a disconnect between price and value. The stock was trading at multiples of revenue that implied it was a software company, not a food manufacturer. Now the air has come out of that bubble. The Invest Online community is learning a harsh lesson in valuation. Just because a brand is recognizable doesn't mean its stock is a buy. Fidelity brokerage data and Interactive Broker stock reports often showed that retail sentiment can remain bullish long after institutional money has fled, creating a bag holder dynamic. We are seeing this play out in real time with BYND. The buy the dip mentality works for high-quality assets like Microsoft or Google, but for a company with negative gross margins and shrinking revenue, it is a dangerous strategy. Institutional activity in Beyond Meat has been telling. Hedge funds have largely moved to the short side or have abandoned the name entirely. If you look at Fidelity mutual funds or Fidelity ETFs, you will likely find very little exposure to BYND in their core growth funds anymore. It has been relegated to the periphery. Short interest remains high, which ironically keeps the short squeeze hope alive in forums. But a short squeeze requires a catalyst, some unexpected positive news to force shorts to cover. Without a surprise earnings beat, a new massive fast food partnership, or a buyout offer, the shorts are comfortable holding their positions, slowly bleeding the stock lower. This is why the stock drifts down on low volume. There is simply no urgency to buy. The macro environment of 2025 is also doing Beyond Meat no favors. Interest rates, while perhaps stabilized, remain high enough to punish unprofitable companies. In a zero-interest rate world, investors are willing to wait years for profits. In a world where you can get a guaranteed return of 4% or 5% in a money market fund or high-yield savings account, accessible via SoFi or Fidelity IRAs, the opportunity cost of holding a losing stock like Beyond Meat is immense. Why risk capital on a company losing money on every burger sold when risk-free rates are attractive? This capital rotation out of speculative growth and into quality and yield has decimated the price action. There is also the competition angle. The moat that investors expected Beyond Meat to have, its proprietary formulation and brand loyalty, has proven to be shallow.